Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsati. And so many things are happening in the market. Yesterday, the government had come out with GST reforms, and in the hope that consumption in the economy can rise and prices can come down and create more demand. And globally, and the tariffs are hurting Indian exports. The rupee is down. Government bond yields are higher, and in this podcast, this is what we're going to talk about in terms of why government bond yields have suddenly spiked. And are still in a bull market, or are they gone to a bear market? And is this just a temporary setback to government bond yields? So let's carry on from here. Before we start, just to get investors to understand, interest rates, bonds do carry interest rate risk, which is risk of prices going up and down. Credit risk, where there is default, corporate bonds can default, and also liquidity risk, where investors could pay a high price for buying or selling the bonds. Getting back to the theme of whether Gsecs are in a bull or bear market. Now, we have seen in the last 3 months that government bond yields have suddenly spiked up from lows. And post the April policy where RBI cut rates and signaled more liquidity into the markets, the 10-year government bond yield, the 10-year GSEC yield, went down to a low of 6.2%. And from here, it's consistently been going up from 6.2% to 6.6%. Currently, where it's trading now, 6.5 to 6.6%. And also, at the same time, the spreads, that is, of the 15-year bond and the 30-year bond to the 10-year bond, has widened. So the 15-year bond spread has widened from a low of, say, 10, 15 basis points, that is, to currently about 40 to 40 basis points. And the 30-year bond has widened from about 60 basis points to about 80 to 90 basis points. And also the state development loans, state borrowing costs have also risen, and these have also gone up. The spreads are widened from 20, 30 basis points to close to 40 to 50 basis points at this point of time, or 60 to 70 basis points in some cases. Now, so clearly, one is that when we do see a spread contraction in the yield curve, it does show that the government bond yields are in a bull market, where because the markets tend to buy into longer dated government bonds and to take advantage of a price increase, because the longer the maturity, the prices increase faster when interest rates higher when interest rates goes down to shorter maturity. Hence, the if you take the 10-year bond, the 10-year bond to the 30, 15 and 30-year bond spreads will tend to contract. But in a bear market, because the fact that if interest rates rise, longer maturity bond prices will fall faster than the shorter maturity bond prices, then investors tend to avoid or sell off the longer dated maturity bonds. Hence, what is happening currently at this point of time is investors' appetite for long maturity bonds is very low because of the fact that spreads have increased, and there is a worry amongst investors that interest rates can rise further, and they will lose a lot of money in if they invest in long maturity government bonds. But the way the government bond yields have moved up from lows has been suddenly very. It's come very suddenly. It started when the RBI said they're going to go become neutral in their policy after a large rate cut, and they even though they mentioned that they're going to do they have their liquidity is very easy in the system, and they're going to be stay neutral in the policy. That was one indication. The second was suddenly the Indian rupee started to fall very sharply against the US dollar. It's trading at record lows, and that's largely because of the worries on the tariffs on exports and many other factors. and also that the investors had seen that foreign investors were pulling out of Indian equity markets, and that also created some kind of a negative sentiment on the Indian rupee. So all this put together, that also created some kind of a weakening bias on the government bond yields, and that also contributed to the fall in prices or rise in yields of government bonds. And the third is obviously now the GST reforms. The government had started to talk about GST reforms. And the worry is that the government yesterday announced that they're going to they're going to have only two slabs of GST, 5% and 18%. So they brought a lot of goods and services under that 5% slab. And though they have increased that luxury tax and other tax to 40%, but the main effect on inflation is lower on the 5% side rather than the 40% side. And hopefully, the government believes that this will spur consumption demand and the economy will start to grow faster with more demand, and that will negate the the downside on taxes collected. GST collections have gone up almost 10% higher CAGR over the last 8 years. Uh, we actually beating nominal inflation, which was around 9%. So that is very clear that GST collections have moved up because of consumption and the economy actually rising. But now with this cut in GST, the government estimates that on an annual basis there will be a loss of about close to 1 lakh crores rupees, right? Close to about 10 $12 billion of 10 $12 billion in the government tax collection loss, and this will increase the fiscal deficit. But going forward, this could be negated by higher consumption and higher economic growth, and tax collection could rise significantly. It's a proven fact that the lower taxes actually improve tax collection rather than or the other way around. But this is going to take a longer term effect, and the markets were a little worried about, whether the government borrowing could be increased for this year because of this lower tax collection, and they could make a two-pronged pump priming to the economy through lower taxes as well as higher spending. But that's not doesn't seem to have come about at this point of time. The government should be able to manage its deficit. Maybe there could be a slight increase in borrowing, but it may not happen anytime soon. It could come at a later date. So these are the main factors that drove the government bond yields higher. Even though the money in the system continues to remain very robust, closer to 3 lakh crore rupees, the liquidity is currently sticking around in the banking system. Even though the Indian rupee has fallen, and for and portfolio investors have been taking out money, which normally leads to depletion in foreign exchange reserves as RBI sells dollar to meet the demand. But this time it doesn't look to have really caused any stress. But there could be, if there is more depreciation in the rupee, there could be some kind of a stress in this. So there are a lot of factors that have taken the government bond yields higher. The question is, at these levels of yields, whether the government bond yields can go up higher, or can go higher, or can it stay in a zone and then look to come down and regain its bullish path. But looking at the way the yield curve has steepened, which is not a good sign for a bull market. Normally, like I said at the beginning of this podcast, in a bull market, the yield curve tends to flatten, where the spreads between the 10 and 15 and 30 year tends to come down very sharply, because people would prefer to invest in longer dated bonds to take advantage of higher price increase and higher returns. And normally, when it's a bearish trend, they would want to cut their losses, and that means they would sell their long dated government bond holdings to reduce their price risk. So, given this, I think the way we are seeing it at INR bonds is that the government bond yields is maybe still not in a fully bear market yet, but it has definitely come out of a bull market, and And if it has to regain its bull market stature, then you would need a strong monetary push with the RBI coming in and giving more rate cuts, and the inflation staying down, and there is risk of economic growth contracting, and all that that will lead to higher demand for government bonds from investors, with and obviously a stable rupee. But if it's going to be a case where the spreads are going to stay high, there is still less appetite for government bond from investors, then this bear market or temporary the bear market phase could continue, and from a temporary bear market, it could go to a long-term bear market as well. That remains to be seen. We are not giving any decisive directional movements on the yield curve yet, but this is where the status is. So there are a lot of other factors to watch out for. So investors who are looking to who are investors would have to watch out for this spreads between the 10 and 15 and 30 year, to see whether they stay stable, or they're contracting on a sustained basis, or they're rising further. So there are a lot more way to long. I think before investors do take a call in investing in government bonds at this point of time, to take advantage of a rise in yields, they should wait and watch for a period of time before they start to do anything else. Having said that, since the liquidity is remaining comfortable, the short end, that is short term bond yields will be more stable than the long term bond yields, because of the fact that a lot of money is there in the system, and that is going to still find its way into safer assets, which are the short term bond yields. Uh, yeah, so that is where we are now. Government bonds have definitely come out of a bull market. Now, are they in a bear market? It is too early to say, but the signs are looking that it is in a bear market, and you'll have to wait and watch before investors take a call. And it could regain its bull market stature if central bank comes and does more rate cuts, given that GST reforms could come bring down inflation and prices of goods and services in the economy. And if that leads to that, if that comes about and the rupee is stable, then the government bond yields could start to trend down again. But that is something investors have to wait and watch. Thank you very much for listening in, and do follow us on all podcast channels.